This is Order Flow Trading Course Lesson 8, Understanding Market Imbalance. My name is Michael Valtos. I'm the founder of OrderFlows.com. Before we get started, as a brief disclaimer, I would like to present to you this presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. CFTC Rules 4.41 Hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve proper losses similar to those shown. Okay, now that's out of the way. Let's jump into Lesson 8, Understanding Market Imbalance. Most of the time, the markets will spend their time in balance. That's why the markets are invented, to facilitate trade. When markets are facilitating trade, the markets are in balance. Buyers and sellers are happy. When the market starts to move out of balance, that's when moves start to occur, trends start to occur. And that's where you're going to get your biggest trading opportunities. If you're trading at a level where price is accepted and everyone's happy to trade, then the market's not going to move. It's when one side starts to take over. Maybe there's a shortage that they know that somebody knows about that's hasn't necessarily hit the market. You're going to see the people with that information come into the market and move the market. It's starting to move out of balance. So in a basic sense, why does the market move out of balance is the question you want to be asking. In a simple form, it's buyers are overwhelming sellers or sellers are overwhelming buyers. What that means is, there's at any given moment you have a group of buyers and a group of sellers. When the group of buyers really, get interested in buying and, they buy all the supply that the sellers have to offer, the price is going to start to move to a higher price. People are being more aggressive and the market is starting to rally. And conversely, when sellers are overwhelming the buyers, maybe there's a lot of inventory on the market. That's going to be hitting the market rather, not necessarily on the market at the moment, but if there even is a lot of inventory currently in the market and it's not being sold, people have to lower their price. And they'll lower their price until they can find buyers. That's what causes the market to sell off. Imagine it, if you're a department store and you bought a lot of winter coats and now it's March and the weather is starting to get warm. Right? You have a lot of inventory of winter coats. You got to start lowering the price. You got to start moving them. When traders talk about a market being in balance, they often think the market is moving in a sideways direction. That's not always the case. The market could be gradually trending higher on slightly heavier buying or lower on slightly heavier selling. It doesn't have to be overwhelming amounts of buying or selling, just enough to move the market away from balance. What that means is, the market doesn't have to be trading in an extremely tight range. The market's going to move up and down just naturally. Markets very rarely stay at one price. It might be just small fluctuations. It's small fluctuations when they turn into big fluctuations. That's when the market is starting to move out of balance. So even though a market appears to be in balance and moving sideways, oftentimes one side is in control. Then the other side takes control, back and forth. So, people talk about choppy markets. And, a market is choppy when you get one side, you get buyers seemingly taking control. Then it gets to a level that not too far away from where you're currently trading. And then the sellers come in and move it back down again. A market is in balance in a general area, buyers and sellers are in relative agreement of price. Like I said, it doesn't have to be one price. S&Ps could be trading at 1900, but it could be, range trading, between 1905 and say, 1897. It's in a range. It's not sticking to one price. It's sticking to an area. Don't think of it as trading in one particular price. It could be fluctuating up and down, above the perceived value for the moment. But it's when it starts to move away very dramatically, that's when a market is out of balance. This picture I like. It's a tank, basically going over a small wall, and when a market starts to move out of balance, that's what it's like to me. Where one side is just basically overwhelms the other, and it's going to take a lot to stop it. In this case, it'll probably take a bazooka to stop this tank. So when a market imbalance occurs, there's one side that is showing its strength, and the market should continue in that direction until the new balance is found. So, a market will move from an area of price congestion or price absorption to the next area of price congestion or price absorption. It's, when it moves from the first level to the second level, that's when the imbalance occurs. Order flows will allow you to pick up on the imbalances in the market as they're occurring. It's not going to tell you after the move's already happened. It's telling you as the move is happening. And generally speaking, a market will trade in balance most of the time. Like I said, a market range trades, about 70 to 80% of the time. It trends 20% of the time. Trend followers make their money when the market's trending. But, unfortunately, the markets don't generally trend all the time. They spend most of the time in balance in a range. So what causes markets to experience an imbalance? Well, there's a lot of things that can happen. New fundamentals could hit the market that, you don't necessarily see. All you're going to see is the after effect in the market. You may, like I said, most traders don't necessarily have access to fundamental data that the big traders have. So, you're not going to know what's causing it, but what you want to know is when it happens. When the imbalance is happening. External events also will cause market imbalances. External events can be things, such as a bomb going off somewhere or a plane being shot down. Unfortunately, most external events are sort of on the negative side, but the market does have knee-jerk reactions to it, and and oftentimes you'll see big moves really quick, and people basically sweeping everything in the book. That's causing imbalances. Stops also cause imbalances. When you get to a level, a stop gets triggered. There's a bunch of orders going to be triggered and go through the market. It's going to basically, a stop will turn whatever's there into a market order, and it'll just sweep the entire book until it stops, and then either more buyers or more sellers will come into the market to add liquidity. Big orders hitting the market will also cause imbalances. You're not going to know when a big order is going to hit the market, but you want to know when that big order, starts getting executed in the market, and you can generally see it in imbalances. Because if it's a big order, and by big order I mean over 1,000 lots, that they're going to have to execute some size at some point. They can't just drip feed in 1,000 lots, basically one lot every 15, 20 seconds. They're going to try and trade it in chunks whenever possible. So if there's size there, they'll go in and grab the size. So, new fundamentals cause imbalance because traders who are privy to new fundamentals are usually the institutional traders who have the money to move a market. They may know that all of a sudden in China that, there may be a new tariff on cotton imports, or new tax on something. Most retail traders aren't going to be privy to that. They'll be asleep when that's happening. but institutional traders, people that are moving the physical products tend to have better sources of news. That's just a fact of life. A market goes into imbalance due to external events such as a plane crash or a bomb going off somewhere. You'll see strong imbalances occurring and the market bouncing around very fast. These imbalances cause the market to move extremely far on a fast move. The market will not indefinitely move in that direction. The market will stop and turn much quicker than normal. So when you see a big spike in the market, and lots of times you don't know what just happened. You do know that, if it's a spike up, that there was very strong buying. You have to watch what happens after the spike. If it's, say, the S&P's rally from 1910 up to 1940 within a matter of, 15 seconds and stop at 1940 and drop back down to 1925. Oftentimes there's, some external event that, you're going to be scratching your head trying to look for, online what happened just now. It'll usually be a quick move up or a quick move down, stop, and a pull back into it. It's something because people are either getting out of positions or usually it's people getting out of positions. Usually when you see something like that, it's more of a move down. You'd see them on these when the news Twitter accounts get hacked and someone spreads a rumor that a bomb went off in New York or wherever, the White House, and that these Twitter algos sort of kick in and start selling the market. And then 30 seconds later, AP comes out and says, "Oh no, that's a false report," and then the market goes back to normal. Those are external events. So keep in mind, markets trend around 20% of the time. That means 80% of the time, the market is doing what it's supposed to do. It's facilitating trade. When the market facilitates trade, both buyers and sellers are happy with the price. That doesn't mean price will remain static. Prices will still fluctuate, but usually they'll fluctuate in a semi-range. They're not going to stay at one price indefinitely. They will move higher and lower, as people are buying and selling. That's the whole point of the market. Imbalances can occur caused by stops being triggered. Usually happens at highs and lows and around key levels in the market. Say there's an important high, a monthly high that's market's getting close to. If we hit that high, oftentimes there'll be stops up there, or say we're coming into I hate to say 200-day moving average, but things that the general public is trading around, you have to keep that in mind. A big stop or an accumulation of stops being triggered will cause the market to go out of balance. Generally, it won't be a very big move. In the S&Ps, it may be 6 or 7 ticks and then stop, and as more people come into the market, or just stop and reverse. If like I said, you got to watch and see how quickly the market reacts, or watch and see if there's going to be additional participants come in to continue the move in that direction or not. Oftentimes at significant highs or lows, macro highs or lows, say it's a new low that you haven't taken out for 6 months, there might be a lot of stops there, and when you get to that point, it could be a complete shift in supply and demand. So you got to take everything into context and have sort of a bigger picture as to what's going on into the market. I'm not saying every day you got to look at charts, but if you write down significant levels such as monthly highs and lows, just know where they are in your mind, or even on a whiteboard next to your desk. It'll help pay dividends for your trading results just by knowing that information, rather than scratching your head after some big imbalance happened and you missed the trade. So what does a stop triggered market imbalance look like? Oftentimes they're characterized by a lot of zeros when the imbalance occurs. Like you see here, we traded through this price at 1872. I think this was a new low at the time, and it just got swept through the market. You could see the imbalances actually started in the previous bar. Then when we got below 1872, it just dropped 4 price levels. That's around 12 or 1300 lots. Even if you add in the previous volume, you're pushing around 1500 lots. So that got triggered, and the market did pull back a little bit. Pulled back up towards the levels of the initial imbalance, and it did continue down lower. You often see them when highs or lows are taken out, and the next bar will often retrace back into it. Market imbalances that are caused by big orders are among the best imbalances to trade because they're often fueled by big money players. What that means is if a big player, an institution, starts accumulating, and there's going to be times where they're going to get aggressive in the market. When you have the imbalance and the market comes back towards that imbalance, if they start appearing again, that's the sign to you that, hey, that someone's starting to accumulate a position. Market trends generally start when there are imbalances in supply and demand. The big players, the ones that have physical demand, that they need to buy to satisfy, or physical supply to sell, tend to show up early in the moves. That's the beauty of, I'll say beauty of institutional trading, but, institutions, they're not the last date to the prom. They get in early on the moves. They're the reason the moves happen. So if you can see what they're doing and understand what they're doing, then, you'll get into trades much faster than, if you're trying to follow an indicator. So when a big order hits the market, it's a sign that the institutional trader is either getting into a position or getting out of a position. Now, you're not going to know which way they're going. You're going to know if they're buying or selling, but you're not going to know if they're getting into a position or out of a position. The best you can do is guess which way based on the market direction, and you'll never know when the trader is about to start executing a large 1,000 and lot and above order. Like I said, take things in context of the market. If we're hanging around the low of the day and you're starting to see buying imbalances come in, okay, that's a sign that someone's accumulating a position and starting to get aggressive at the lows of the day. The market should start to move. Should start to move up rather than continuing down, because where you're aggressive sellers, all you're seeing is aggressive buyers. If you're up near the high and you're seeing aggressive buying, that's normal. That's what you want to see. Oftentimes it's going to be people coming in late to the party. Where would you rather be buying? When the market is out of balance, would you rather be buying imbalances near the low of the day, or would you rather be buying them near the high of the day? I prefer to buy them near the low of the day. Now, order flow, what it allows you to do, it allows you to see once the order is being executed, if the trader is being aggressive to get the order done. If he is, the trader will cause a market imbalance. When the trader needs to get the order done, that's why he's being aggressive. Maybe he has instructions, I hate to say don't fuck it up, but sometimes the portfolio managers will tell the execution trader, just get me in and try not to push the market. There's going to be times where the trader has to be aggressive and get some on. He knows he's going to move the market, so if he can get some on, be aggressive early, he'll look better. His average price will look better to the portfolio manager. So there's going to be times where traders are aggressive in the market when they've got a big order to get done. They've got to show some strength. If there's size in the market, they got to buy it. Or if they're trying to sell, move size, on the sell side. If there's a solid bid, they will sell into it. Most big traders, they're not necessarily concerned about the individual prices. Say they've got 2,000 lots to trade. They're only concerned with the average price. They know 2,000 lots will have an effect on the market. What they're concerned about is the average price. They're not concerned about the 10, different price levels. If they could get most of it done at a fairly cheap average price, they're happy to get it done. Sometimes it's sort of like, I hate to say driving a bulldozer through the market, but when someone's got a big order to do, oftentimes they want to get some on board, and I hate to use this this picture of a bulldozer with money, but oftentimes that's what it's like, really. The institutional guys, they've got a big position, they need to get it done, and sometimes they'll just bulldoze right through the market, and on the way they're going to start the trend and get it moving in their direction. So just break it down for you. This is an example. A sales trader at UBS needs to buy $100 million worth of E-mini futures. The market is currently trading at 1900. At the current price, one contract of ES has a notional value of $95,000. $100 million worth is equivalent to basically 1,052 contracts. You round up, so the trader needs to buy 1,053. So generally speaking, the E-mini market is a few hundred deep at each level. So what he'll do is he'll buy up to a say the market's offered at 1900. He'll buy, he'll try and buy up to a price of 1901 and book the average price. He'll buy, if the market's offered at 1900 and, maybe there's 200 on the offer there at 1900 and maybe another 200 offered at 1900 and a quarter, 300 at 1900 and a half, and some at, 300 at 75 and at 1901 there's 500. He's confident to put his order to buy 1,053 contracts up to 1901. His average price will probably come out to 1900.375 or something like that. It'll be spread out, but his average price is below where he's going to move the market to. So in general he should be happy, and at the same time the market is now trading higher. So in a sense, I don't say he got a better fill. He knows he's going to move the market, and if he get most of it done at a price lower than where he's going to move the market to, it's a good fill for the most part. So here's an example of an imbalance. Okay, so the market is moving higher. It's going up, and when we get to this level here at 28.96, and you get a selling imbalance, you're thinking, okay, the market's going to go down now. Well, what happens? The market instead goes the other way. Well, you have to read what's happening in the market. You can see that even though you have this selling imbalance, you have buying imbalances that came in to sort of negate the selling imbalance. You want these sellers to be back in here, and the market did come back up. You do see some selling imbalances, but buying was enough to overtake it. Market imbalances, they don't always work. It's not necessarily a end of a trend or a continuation of a trend. So, like I said, sometimes it's just a big order that needs to get done. Like I said, the market is rallying up here. We're heading up to 2900. This is in the Euro stocks, and there's somebody in here that got 1,000 to sell. It could be someone that bought some, earlier, and they're happy to sell it, at around the 95 level. They're going to get their average around 94, 95, 94 and a half. To move 1,000 lots. People are going to trade where their size. Does the person get out, prematurely? Yeah, maybe. Who knows? They're happy. You don't know if they're taking profits or they're trading against something. I said, imbalances, they don't always, signal the end of a move, but, what's important is you should watch what's happening after the imbalance occurs. If you have a selling imbalance and all of a sudden you see buying imbalances, going in the opposite direction, it could just be a sign that maybe there's a big order that got executed in the market, after a move. And now the move's going to continue on because you're seeing, the aggressive buying come back in. Take everything in context with, what's happening in the market. Okay, so this is a case where you have market is starting to it's kind of in a range down here. This is 5:45, 6 o'clock, 6:30, 7 o'clock, and we're starting to move away. Okay, there's not necessarily anything in here that's telling you, and then wham, you see this big buying imbalance, 3,000 lots. It really stands out. 3,374 is your imbalance, and your volume is literally the biggest volume you've seen anywhere in here. I think the biggest one prior to that was 3,329, and here you got 3,374. That's a sign that market is someone is being aggressive and basically buying whatever in order to get their hands on to move the market. I mean, when you see things that stand out like this, you really gotta, your ears will prick up, and you'll want to try and jump on board and go the same direction as that trade. Now, this is another interesting chart. This is in the crude oil. Now, imbalances occur for, many reasons. You don't necessarily know why it's occurring, but you should, take everything and try to understand what's going on. So, we're going up in the market. You get a buying imbalance, just as you sort of take out this previous high. So you take out the high and you get a buying imbalance, which is what you like to see when you're taking out the high. And, the market makes a new high, comes off a little bit, again, goes back up and makes another new high. And what do you have up there? You got a divergence. So you got a negative delta. And then in the next bar, you got strong selling. You got a selling imbalance. It's almost at the same level of the buying imbalance earlier. So, you're seeing a shift in supply and demand. Demand was very strong here, but it reached this level. All of a sudden, there's I'll say no more demand, but there could be some supply up here. People could realize that, hey, it's expensive. They should look to be selling it. What's important is you have this buying imbalance, and then immediately after it, after you make the high, all of a sudden you got a lot of selling come in. The market is now out of balance up here. It looked like it was sort of in balance. Like I said, sort of reaches high and going sideways, but then you hit the high, and then you have a selling imbalance, at the high. That's why I said I'm more inclined to take buying imbalances near lows and selling imbalances near highs. That's just because that's where you're going to see shifts in supply and demand. Okay, this is crude oil again. We're working our way up. You got some buying imbalances, a couple in this bar, and then in this bar where you hit the high, you have a buying imbalance right underneath the high of the bar. Okay, what just happened? You hit the high, you got a buying imbalance right up at the high, and the market got one tick above it and turned around and sold off. That's telling you that, again, there's a shift in the supply and demand. You're having a buying imbalance right at the high. Why isn't it following through? You should be continued to make new highs. If you're getting buying imbalances at the highs, you shouldn't all of a sudden be selling off and dropping 10 ticks right after you hit the high, with some aggressive buying. What it's telling you is that there's people, I don't say are trapped, but people are long and wrong. It'd be the opposite if it was at the low, but in this case it's at the high. Okay, crude again. So you're working your way up, from a lower level. You got a buying imbalance here, and it's a bunch of zeros. It could be stops. It's very good volume: 426, 169, 58, 120. The next bar retraces a little bit into it, but it comes right back down to this point of control and continues up. Is this a stop and trigger? Is a stop induced imbalance? It's hard to say. It could just probably is, because there was a lot of volume here. It could be there was an iceberg order, something holding the market. It could have been an arb order. And if you get through, usually when you get through these big offers in the market that are holding the market down, once you get through it, the market can really put a move in afterwards. It's hard to say, but I think that once the market got through this level, it it triggered us. Some people had stops behind it, and triggered it a little bit higher. To me, this looks like a stop-induced imbalance. Okay, so what is this? This is E-minis. What's happening? You're working your way up, and you're seeing buying imbalance, buying imbalance, buying imbalance, buying imbalance, buying imbalance, buying imbalance. You hit the high. Then all of a sudden, the first time you see selling imbalances, 1300, 700. Okay, after this high here, the market turned down. You want to see what's happening in the next bar. Earlier you hit the high, turned down, but then you're met with buying imbalances again, in the continuation of the move. Here you hit the high. There wasn't any buying imbalance or selling imbalance. But in the next bar, all of a sudden it's telling you, hey, there's some aggressive sellers in here. There's more aggressive sellers. You're getting the imbalances appearing. Like I said, it's the first time you see any imbalances appearing, in this little move up. That should be alerting you to, hey, get ready to get short. Then in the next bar, you're seeing, sort of, a few additional things. You see 2 more imbalances. You see a single print there, and then the market, it proceeded to sell off, quite nicely. So this is a Euro Stoxx chart, and what you're seeing in here is a couple of things. Okay, first of all, you're seeing some point of controls right at the same levels in here. Sort of indicative of a market that's just going sideways. You could use them as support or resistance levels. In this case, what really stands out is you have these imbalances right at the bottom of green candles. And, what that's telling you is, there were some aggressive sellers trying to get the market to go lower. You have these 4 imbalances right at the exact same level. And, the market would only sell off by a couple ticks. Then you get in this last bar here, and, you got a selling imbalance of 233. It's decent size. It's good size. Why isn't the market going through? Obviously, there's somebody there bidding the market. Basically, palms facing in, willing to buy whatever, people are willing to sell. And, the sellers just couldn't get past that level, and the market pops up. And then again, you get this 370 lots selling imbalance right on the low of this bar. It happens to be exactly at this point of control. Obviously, someone's, interested in buying here at this level. The sellers can't push the market through this level, and the market bounces back up. Knowing where imbalances are appearing in bars is also important. When you see them in green candlesticks, selling imbalances at the bottom, and the market can't get through it, obviously it's a sign that there's somebody in there trying to I'll say support the market, but someone's in there, they've got some buying to do. Okay, so this is a E-mini chart, and you have this buying imbalance. The market's moving up. You have a buying imbalance here at this is around the 1901 level. Market starts trading above it. It's trading above it for the next 5 bars, and next 3 bars. It starts coming into it, especially in the 3rd bar. And then in the 4th bar, it comes back into it. Comes back and it covers basically the whole area where the imbalance was. What you want to notice is, if there's going to be an imbalance, are the buyers going to reappear again when the market comes back to those levels? Here you can see the market pulled back into the area, it's literally retraced the whole zone, got through it, by 16 lots traded on the other side of this buying imbalance. But you're seeing a lot of volume down in here, 2400, 1600, 1200, even what's traded on the offer, 1600, 1600, 1100. Here you have a buying imbalance. To me, this is a sign that, the people that were interested in buying earlier, they're still interested in buying. The market can't necessarily get through this volume again. Now it's much more volume than you saw earlier. And the market puts in a nice little rally up. I mean, that's why my software, order flows trader, will draw a zone out, from where the imbalance occurs. It'll draw it out 5. You could adjust it. I have it set to 5 bars, 1, 2, 3, 4, 5. For me, it's not necessarily a zone that's going to hold all day. I'm just looking at it in the short term. I find that 5 bars, if it's going to be support, if it's going to be a buying imbalance, I'll treat it as support. If it's a selling imbalance, I'll treat it as resistance. So, I'm going to watch to see what happens when the market comes back inside the zone, if it's going to hold or not. Okay, so here's, sort of in the opposite direction. S&Ps are starting to work our way lower. We took out this low here at 1901. Coming into this low, you have a selling imbalance. It's not the biggest selling imbalance. The volumes are kind of light. 191, 159, 278. But you have a lot of selling imbalances in this bar. Especially after your high of the move bar, just before it. And okay, so say you're not necessarily convinced in this bar that it's happening pretty fast. You may not be able to get short, but then in the next bar, again, you're seeing more selling imbalances. And the market pulls back into the zone and continues to sell off, just as it did in this bar at 901, the first bar at 901. You retraced back up into it and then sold off again. So, knowing where these are happening, is important. And watching when it pulls back into the area of the imbalance, if these sellers, in this case it's selling imbalance, if they're going to reappear. If they're going to reappear, you're going to be using these levels as your resistance levels. Okay, again, this is the E-minis, and you have, this bar here at 1427, which is pretty much the entire bar is a buying imbalance, pretty much. And, what happens? The market pulls back into it twice. It can only get through, the first 2 levels. Before it continues in its direction. These are the types of moves that you want to get in. Where you're seeing the imbalances reoccur, you're seeing the aggressive buying reoccur. It's almost as if this person had say 1,000 lots to buy. Let's say a couple thousand. They buy it the first 1,000, they move it up. And they're going to let the market breathe a little bit. They've moved the market. Let the market come back in and buy some more. Let the market go back up, come back in a little bit, buy some more. That's what's happening there. And the market, just finally, continues its move up. Okay, well, this is one that's sort of, I believe, happened around a number, or some news. It's, you're getting these imbalances, and what's happening is, the market is retracing back into it. You see it starting to move here at 832, pulls back in a little bit. Again, you get some more imbalances, pulls back into it again. Up here at the top, it pulls back into it a little bit. Then you get this big imbalance right up here at the top, and we're still in that zone. You can't get through it on the other side. We spent some time, a little bit below it, but we're sort of, being supported here, but we can't get past it. Where are these buyers here? Why are they not reappearing, later? So, if it was, people are being aggressive here, they're thinking, hey, the market's going to start to move higher, but, they're not able to move the market higher anymore. They sort of, bought all they could. They don't have any bullets left to keep buying. And you're seeing, we're just sort of hanging around this area in this zone. Why aren't we moving higher? You're not seeing any more buying imbalances coming in here to move the market higher. All you're seeing really is now you're up here at the high and you're seeing selling imbalance, selling imbalance, selling imbalance, selling imbalance, selling imbalance. Yeah, you have one here, 51. That's not much. Selling imbalance. The market is just sort of hanging around this level, slightly lower. That's why, so I'm not usually the type of person to be, taking buying imbalances near the highs. There are times when I do, but, most of the time I tend not to. Okay, so, here's here's the rest of the crude charts. What's happening? We're starting to sell off. Okay, you have a selling imbalance here, and what happens? The market sells off. You get, a couple buying imbalances to sort of move the market higher, but then you get back into this zone here where you have this initial selling imbalance. you get through it, you're sort of hanging around. Then in this bar, you get the selling imbalances reappearing, that you have here earlier at the same price, and the market just moves lower. It just eats right through, these buying imbalances. When you get a selling imbalance, right, then you get a buying imbalance. It's, shortly thereafter, it's indicating a change in trend or a change in supply and demand, at least temporarily. So, initially you're short off of the selling imbalance. Your mindset is short, rather, thinking the market's going to go lower, but then lo and behold, you get a buying imbalance and the market starts to trade higher, and then another buying imbalance. You could have realistically gotten along within this buying imbalance here in the next bar when it pulled into it. But then when you get this next buying imbalance, there's no reason to still be long here. It's telling you sellers have taken over, and then the market just fell over. So I said, don't necessarily think that, a buying imbalance is going to, set the direction for the rest of the day. You could have a selling imbalance and immediately afterwards you get a buying imbalance. That's just the facts of life. You got to deal with it and know how to trade it. You're short, but then you have an opposing buying imbalance. You got to get out. I don't necessarily say you got to get long. At least get out first and then decide if you want to get long. And then you get a selling imbalance, shortly thereafter. So, if you're long, you definitely got to think about getting out. You got to respect what the market is telling you. Honestly, you don't necessarily see them as happening as fast as this. It does happen once in a while. And, crude is one of those markets that can turn on a dime and really start to, sort of say snowball, but, get a lot of people piling in at once. That you're seeing imbalances. Okay, so that's the end of lesson 8, understanding market imbalance. In the next lesson, I'll explain the importance of point of control, also known as POC, commitment of trader, COT, in the bar. It's what it is. It's the area with the most volume traded inside of that particular bar. It does have implications as to supply and demand, and we'll get into that in the next chapter. Thank you, and again, we'll pick it up in chapter 9.